This is Nightly Business Report with Tyler Matheson and Sue Herrera.
April showers. Stocks close out the month with a sharp sell-off, and some market watchers are not expecting any May flowers.
Refined earnings. Oil's slide hurts Exxon's profit, but the company's results beat the forecasts thanks to a five-fold profit rise in refining.
And padding your nest egg with stocks still at lofty levels, is now the right time to take your retirement money out of stocks? All that and more tonight on Nightly Business Report for Thursday, April 30th.
Good evening, everyone, and welcome. Glad you could join us. Well, sell in May and go away. That is the old market cliche. And today, it was as if May started a day early. Stocks began the session lower and just kept on going down, extending their losses into the late afternoon as some of the big market gainers in recent months, like small caps and biotechs, lost steam. By the close, the Dow Jones Industrial Average was off 195 points to 17,840. The Nasdaq was down 82, and the S&P 500 fell about 1% or 21 points. Despite today's sell-off, though, all three of the major indexes finished the month in the black, with the Nasdaq and the S&P up nearly 1 full percent. Yield on the 10-year Treasury note held just above 2%. That level is watched closely because it's seen as a proxy, basically, for the health of the U.S. economy. Bob Bazzani at the New York Stock Exchange has more on today's week close to April.
It was a poor end to the month as several big trades started to unwind a bit. And remember, there have been three trades that have been big winners this year. First, long the dollar. Second, long Germany. And number three, long healthcare, particularly biotech. Now, these are what traders call crowded longs. That is, a lot of traders have bought into these trades and are sitting on a lot of profits. All three of those trades have come unwound a bit this week. What happened? Well, first, weak economic data in the U.S. has caused the dollar to weaken. The dollar index is down nearly 4% just this week. That's one long trade that's not working. As the dollar has weakened, the euro has strengthened. That's bad news for the German stock market, down more than 4% this week because a stronger euro makes that country's exports more expensive. That's a second long trade that isn't working. Finally, some recent disappointments in earnings from several biotech companies, including leader Biogen, has caused a pullback in that space. Biogen's down almost 12% this week alone. That's strike three. All three long trades aren't working anymore. So what should you do? Maintain some perspective. It's true, some of the best performing sectors have had a tough week, but all of them remain up for the year. And the S&P 500, that is the benchmark after all, it's only 1.6% from its historic closing high. You know when that was? It was just last Friday. Doesn't that seem like a long time ago? For Nightly Business Report, I'm Bob Bassani at the New York Stock Exchange.
Daniel Morris joins us now to talk more about the markets and what lies ahead in May. He is global investment strategist at TIAA-CREF Asset Management. They have about $866 billion under management. Good to see you, Daniel. Welcome.
Thank you.
I know you feel that we're a little stretched in terms of valuations, but you're still looking for pretty decent earnings growth for the rest of the year, correct?
Well, I guess it depends how you define decent in this environment. After the really good results we've had over the last several years since the bottom of 2009, we're at a point where you're looking for perhaps high single-digit earnings growth, excluding the energy sector. So that's okay, but certainly much less than we've had recently. And I think the big challenge for the market is that we have relatively high valuations, and that type of earnings growth, 5, 6, 7%, may not be enough to support the multiples that we currently have on the market.
So if I'm hearing you correctly, Daniel, it sounds like you would not be surprised either to see a bit of a sell-off sometime over the next few months, or at the very least, a market that kind of treads water.
Yeah, absolutely. And I think the biggest factor behind that is the fact that we are nonetheless expecting an increase in interest rates by the Fed, looking for September now. And if you study stock market history, what the stock market does ahead of hikes, the first hike by the Fed, there's often a correction around 4 months, give or take, before that first hike. So if we're looking for September, you can do the math. Sometime spring, early summer, it wouldn't surprise us if we did see a sharper sell-off.
So if valuations are stretched here at home, globally, where would you deploy cash? Where are the values?
Well, I think the question as much is earnings growth as opposed to valuation. I think what we really see in Europe and in Japan is the opportunity for accelerating earnings growth. And you really are seeing that now in Europe. Quite good economic numbers starting to come out, analysts increasing their earnings forecasts for companies, particularly in the Eurozone, and that's going to translate or should translate into stock price appreciation. We had great returns in the first quarter. We think they're going to be strong into the second quarter as well.
TIAA CREF is one of the biggest and one of the best asset managers in the country, if not the world. I'll go a little differently here, Daniel, and ask you how much of your equity money is indexed as opposed to actively managed, and why?
Well, we certainly offer both products. I think it depends on the investor and their own particular situation as to which is appropriate. We do have a significant amount of funds that are indexed, but for the most part, we really do believe in the virtues of active management. We invest quite a bit in research and our own analysts to give the recommendations to our portfolio managers, and that's really where we think we add value.
Daniel, very quickly, talk to me about fixed income and bonds and your exposure there, if anything at all.
Well, I think what's been interesting is this increase in interest rates, the Treasury going above 2%, even as you've had the stock market sell off. And I think what we're seeing there is a reflection of actually the increase in oil prices, increase in inflation expectations, and we think both of those forces are going to continue. So we're still looking for higher interest rates in the months ahead.
All right, Daniel, thank you. Daniel Morris with TIAA CREF. Ty?
Well, Sue, Visa out with the results after the bell. They're closely watched because it reflects the health of consumers worldwide, but maybe especially here in the U.S. The Dow Component's earnings came in at 63 cents a share. That was a penny better than estimates, but roughly flat with the same period last year. Revenue of $3.4 billion was better than consensus and higher than last year. Still, shares were lower initially after the close, as you see on that graphic. Morgan Brennan has the one key takeaway for investors. Morgan?
Okay, so as you mentioned, we saw better than expected results, but net income still decreased profits. They decreased 3% in the quarter, and that was largely due to the stronger dollar and the fact that lower gas prices weighed on the results. The other thing to keep an eye on is the fact that operating expenses increased. We're seeing this company continuing to invest more into technology geared towards mobile and other types of digital payments, and that's really, I think, the key here, because CEO Charlie Scharf made a comment in the results tonight. He said there's trillions of dollars of cash to disintermediate, and our work in digital payments will allow us to capture more than we could have contemplated a few years ago. So the results were better than expected, though we did see the decline and some of those headwinds that we've been seeing in other companies' earnings this quarter. But longer term, they really see a big opportunity here in the mobile payment space.
That's where it all seems to be going. Morgan Brennan, thank you very much.
Meantime, more earnings to tell you about. Exxon Mobil's first quarter profit was nearly cut in half from a year ago due to that decline in oil prices. But the results were enough to beat lowered earnings expectations pretty much by a mile. Shares of Exxon Mobil dropped today, but of course that was along with the rest of the market. Jackie DeAngelis has more.
A big beat for Exxon Mobil, even if expectations were drastically reduced. Revenues are down more than a third from a year ago, almost mirroring the 40% drop in oil prices during the last 12 months. Exxon and other energy companies are all making moves to reserve cash. CEO Rex Tillerson saying the company doesn't expect oil prices to rebound quickly, despite the roughly 10% bounce we've seen so far this year. Oil prices are hovering near their highs for the last year, but traders agree crude could stay near $60 a barrel for some time.
I do think oil has found its short-term bottom. Dollar influence is number one. There's a few other factors that's also supporting prices. If you're a company, an oil producer right now, and you survive the $42, I certainly see a brighter future ahead for you.
Investors took notice when its report mentioned lower crude prices improved the profit margins for its refining operations. A 4-cent dividend raise to 73 cents a share also made investors smile. Refining profits are a common theme this week, softening the blow from reduced overall earnings for Royal Dutch Shell, BP, and Total. Smaller companies that don't have big refining operations have not fared as well. ConocoPhillips also beat by a penny. It was one of the first big U.S. oil companies to cut back on exploration spending. Tomorrow, we'll hear from Chevron, the key to its earnings report if it'll slash its capex even further. The company is looking at a 13% cut right now to $35 billion. But will those plans change? Exxon is sticking to its capex cuts, 12% for 2015. The question investors are asking is, when will these capex cuts start to impact U.S. production?
I think the capex cuts that were announced at the beginning of the year have started to take effect already. If you look, there's not any new rigs being deployed right now. A lot of rigs, 52% of them, have shut down. And what we're seeing as far as supplies go, it's starting to make a difference.
Though crude prices are stable for now, the longer-term picture is still volatile, and that means exploration spending cuts will likely continue. For Nightly Business Report, I'm Jackie DeAngelis.
To the broader economy now, where the American job market does continue to show signs of recovering. The number of Americans filing new claims for jobless benefits tumbled to a 15-year low last week. Initial claims fell 34,000 to a seasonally adjusted 262,000. That is the 8th straight week below 300,000. A separate report showed that wages for private sector employees climbed 0.7% in the first quarter. That is the biggest gain in more than 6 years.
Over in Europe, consumer prices stopped falling in April, and that is easing concerns that Europe was headed for a long bout of deflation. The European Union said consumer prices were unchanged, in line with market forecasts. Meantime, the European Central Bank said that while its stimulus program was working, the economy still has a ways to go.
European Union is still in tense negotiations with Greece over its pile of debt. But small signs of progress are starting to emerge. Michelle Caruso-Cabrera has more.
Things just got real between Greece and its creditors. After months of sniping at each other in the press, they're finally in the middle of negotiations, and you can tell they're real because both sides have agreed to a news blackout. The Greek government says it is willing to make some big concessions, like not raising the minimum wage, as they had promised their voters they would do. They've also agreed to do privatizations, which they had told the voters they wouldn't do. The Greeks, though, may be under intense pressure after new polls show the population is growing impatient with the new leadership, and that over 3/4 of Greeks feel that Athens must strike a deal at any cost to stay in the euro. So the Greek government has sent a bigger team, perhaps to dilute the role of controversial finance minister Yannis Varoufakis, and the talks are expected to continue until at least Sunday, with Prime Minister Tsipras willing to step in to speed things up if necessary. That's according to Reuters. Greece wants an interim deal by next week, hoping that that will allow the European Central Bank to ease liquidity restrictions on the country's banks. That's before a nearly $1 billion payment to the IMF falls due on May 12th. Athens has suggested it would struggle to pay that installment. For Nightly Business Report, Michelle Caruso-Cabrera.
Still ahead, where Ford Motor sees the future of the automotive industry, and it's not in Detroit. Henry Ford may have been the man who made Detroit the Motor City, but today the company bearing his name is looking west for innovation, specifically Silicon Valley, where the automaker has opened a technology center. Phil LeBeau has more from Palo Alto, California, on Ford's push into the heart of the tech industry.
It's a very different environment.
Ford CEO Mark Fields calls this the future of Ford. Far from the nearest assembly plant or a design studio, Ford is working with the latest technology in the Silicon Valley to develop cars and trucks.
The level of intensity that I'm hearing from talking with folks I meet out here, they have never seen the amount of interest in one industry by this community in a very long time.
Ford and other automakers are racing to make sure Silicon Valley giants like Google and Tesla do not take the lead in building connected and autonomous drive vehicles. That means giving consumers tech features they want behind the wheel.
They're coming in and saying, well, I need Bluetooth, I need streaming audio, I need these different technology components that's going to make my life easier. And so I think Ford having a presence in Silicon Valley is really going to kind of keen them into what is relevant to consumers and to develop products that make sense for consumers.
There's no way of knowing what the next breakthrough in technology will be from Ford. But Fields says thanks to technology like this virtual reality headset, the vehicles of the future will be changing rapidly.
Things like, lane keeping, collision alert, adaptive cruise control. You can get that across our lineup, and you're going to see us build on that going forward.
The apps are still being written, and cars packed with even more technology are still in development. But Ford is betting it will be ready as automakers drive further into the Silicon Valley. Phil LeBeau, Nightly Business Report, Palo Alto, California.
From Ford to General Motors says it will invest nearly $5.5 billion in its U.S. factories over the next 3 years. The company says the move will create 650 jobs. The announcement comes just a few months before the automaker begins bargaining the next contract with union workers.
Sales at Viacom sank on weak ratings, and that's where we begin tonight's market focus. A decline in domestic ad revenue weighed on the media giant's top line. Foreign exchange issues and a drop in filmed entertainment sales didn't help either. The MTV owner's profit beat for the quarter, but still shares fell almost 4% to $69.47. Time Warner Cable missed on both fronts. The cable operator said it did see a record number of subscribers in the quarter. As for the takeover deal with Comcast that fell apart, the CEO says he's still looking to create value for stockholders.
We've never needed to be larger. We've always been guided in our M&A approach by a single principle, which is we're going to do whatever maximizes value for our shareholders. That principle still applies.
Shares were off by 1.5% to $155.39. Sony says it will bounce back to profit for the first time in 3 years, helped by strong sales of camera sensors and cost cuts. This is the Japanese consumer electronics maker seeks to turn around its loss-making mobile phone business. But results came in below average estimates. Shares fell 1.5% to $30.24. And Beazer Homes announced a loss that was smaller than analysts were expecting. The home builder's revenue topped forecast as new orders jumped more than 20%. Shares were off just a fraction on this down day to close at $17.51.
Cigna's quarterlies trumped the street's estimates, and the company upped its full-year outlook. This as the insurer added more customers and increased premiums. That always seems to help. CEO says that was a sign of the company's growth strategy at work.
The key for us is growing customers and expanding relationships. So the meaningful driver for us is our customer base continues to grow. For example, we've been executing our strategy for 5 years now. 5 years ago, we had about 60 million customer relationships around the globe. Today, that's in excess of 85 million customer relationships.
Shares, though, fell more than 1.5% on this down day to $124.60. After the closing bell, AIG said first quarter earnings fell slightly. This is low interest rates and weaker returns from alternative investments offset improvements in the company's commercial lending business. The insurer authorized a buyback of $3.5 billion worth of its shares. Those shares were higher initially after the close, but before the bell, the AIG shares were down a fraction to $56.29. A weak outlook sent shares of LinkedIn plunging after the close. The social network for professionals posted results that topped estimates, but the company slashed its full-year earnings and revenue projections. Shares down as much as 26%. In regular trading, though, the stock was off $5 to close at $252.15. Gilead Sciences declared its first quarterly cash dividend, 43 cents a share. That came along with the drug maker's earnings results, which were better than estimates. After the close, the stock popped initially. Before the bell, shares fell along with the market almost 2% to $100.54.
Well, biotech stocks may be having a hard time of late, but the same cannot be said about the city where many of them are headquartered. Cambridge, Massachusetts is not only home to two of the world's greatest universities, Harvard and MIT, it is also home to Kendall Square, now known as biotech's capital city. And as more biotech companies move to that area, big money is following. Meg Terrell has the story.
Oh, it's a couple blocks away. Everything's a couple blocks away.
Entrepreneur Mike Gilman doesn't have to go far from his Cambridge, Massachusetts office for board meetings. He's smack in the middle of one of the biotechnology industry's capital cities in its marquee neighborhood of Kendall Square. With 130 life sciences companies in 2.5 square miles, the neighborhood surrounding MIT lays claim to the densest concentration of biotechs in the world. And as the industry has boomed in recent years, so has Kendall Square real estate.
In the last 2 to 5 years, we've really seen this explosion in not only startup activity, new companies, but traditional large pharmaceutical companies that have, in the past decade or so, embraced biotechnology. They have arrived here on the scene in Kendall Square.
That squeezed vacancy rates to historic lows, down to 3% in the first quarter, according to real estate firm Transwestern. And as for rents, they've doubled in the last decade to $71 per square foot. That hasn't stopped biotechs like Alnylam from expanding in the neighborhood. The drug maker just signed a lease to move into almost 300,000 square feet of new space in Kendall Square, and the option to move into another building now occupied by Genzyme 3 years from now.
When we thought about where to be, we didn't think twice about Kendall Square was where we wanted to be.
Biogen has also returned its headquarters to its Kendall Square roots after a stint in the Boston suburbs.
It's different being here, right? Our headquarters out in Weston, we're in the suburbs. It's a lovely building, beautiful grounds. But for me, it was a little too much like a country club.
Big pharmas from Pfizer to Novartis are also expanding in the neighborhood, all seeking proximity to MIT, Harvard, Mass General Hospital, and other major research centers, not to mention the hot biotech startups that may contribute to their pipelines. Some worry, though, that the land grab in Kendall Square will squeeze out the little guys.
This area is now becoming sort of gentrified. All sort of the rich people are moving in, and they're tearing down and they're building up these fancy palaces. So it is a challenge, and I'm hoping we don't have to go out to the suburbs.
For this booming industry, it's all about location, location, location. For Nightly Business Report, I'm Meg Terrell in Cambridge's Kendall Square.
And to read more about the Boston biotech real estate boom, head to our website, nbr.com.
Still ahead, with the stock market at such lofty levels, should retirees or people nearing retirement take their money out of the market? Advice next.
Here's a look at what to watch for tomorrow. The big automakers report their sales figures for April. On the earnings front, expect to hear from Chevron before the opening bell. Manufacturing data will be released along with the final consumer sentiment read for April. And that's what's on the agenda for Friday.
And some positive news on the retirement front. The average 401k account balance reached a record, and workers are apparently socking away more in their IRAs. This according to Fidelity's quarterly retirement report. The average 401k held $91,800 in the first quarter of the year. That's up about 3.5% from a year ago. A record 23% of employees in Fidelity plans increased their 401k contributions. And average IRA balances also hit a record at $94,000. Much of the gains are due to the rise in the stock market.
Despite today's sell-off, stocks are sitting at lofty levels. So is now the time for retirees to move some of their money out of stocks? Sharon Epperson joins us now with a look at what you might want to do with your money. Sharon, it's good to see you as always. And
good to be here.
So far, it's been a really pretty great run. The markets have had several years of substantial growth with no major corrections. So should retirees consider cashing in at this time?
Well, you know, those folks that are near retirement or that are already retired, they may be wondering whether or not now is the time to kind of cash in on some of those profits because they want to make sure they have the income to live on so they don't outlive their money. But there's some careful considerations that need to be made in terms of their risk tolerance and in terms of the returns that they really need long term because they could be spending decades in retirement.
So what about retirees who've basically made up their minds that they want to lock in some gains? What should they do and where should they migrate the money?
Well, the first thing is that they need to review their portfolio. And a good rule of thumb, we talked to a number of members of the CNBC Digital Financial Advisors Council, and they advise that make sure you have at least a year's worth of cash in your portfolio so you're not forced to liquidate stocks at a time that may not be the best time to do so. Once you've reviewed your portfolio, then it may be time to rebalance because, after all, we have seen this tremendous run in the stock market, in U.S. equities in particular. And so without this correction, you may be overweighted in certain categories in the U.S. equity market. So you may want to rebalance your portfolio to make sure that you're more in line with your goals, and that would require you to liquidate some of those stocks. The other thing that you need to do now, though, is to reallocate. Once you've decided that perhaps you're overweighted in some areas, you may have little or no weight in a very important area, and that's international stocks. Look at how well European stocks and so other developed international economies have done, and look at what may be coming with quantitative easing. A lot of advisors say it's important for retirees, near retirees, to consider putting some of their equity exposure into international.
And for those who do want to rebalance, what advice can you give them?
Well, a lot of folks are saying, I'm retired, so I want income. A lot of my money is in fixed income, and so how do I rebalance that portion of my portfolio? And there, as we know, interest rates are likely going to rise at some point, and you want to try to have bonds that are more or less not that sensitive to the interest rate fluctuation. So you want to look at things like floating rate loans, look at bonds with higher yields and shorter maturities, and also consider, if you're not one who's buying individual bonds, look for an unconstrained bond fund. That's something that a lot of financial advisors say may be a good one to give you some flexibility and delve into different aspects of fixed income that you may not be able to do yourself.
So a very quick answer here. Right now, a lot of people are saying in bonds, favor those with short maturities, right?
Well, yes, shorter maturities, higher yields, that's where you want to go with the bond market.
All right, Sharon, thank you, as always, our expert, Sharon Epperson. And for more money tips on retiring and retirees, head to our website at nbr.com. And that does it for Nightly Business Report for tonight. I'm Sue Herrera. Thanks so much for joining us.
And I'm Tyler Matheson. Thanks from me as well. Have a great evening, everybody, and we will see you right back here tomorrow night.